Welcome to ETF IQ. I'm Sonali Basak, in for Katie Greifeld and for Scarlett Fu. Let's get to the biggest stories right now in the more than $15 trillion global ETF industry. U.S. stocks under pressure to start the week. Tech remains one of the biggest laggards so far in 2025. And we've seen volatility not just in the United States, but also across the pond in the UK as global yields surge. And in just a moment, we're going to be speaking about all of the market stress with BlackRock's Kristy Akullian. And as always, Eric Balchunas from Bloomberg Intelligence is here with us, and he is looking at the close.
Thank you, Sonali. And you said it, under pressure. That's a good word for it, especially on the tech side. Let's go over what we see on the inflows first. So, VU, $6.6 billion. Again, ridiculous. This thing's on pace to actually break its record. I mean, it's early, but it's on pace to break last year's record of $116 billion. So it hasn't really let up since its record year last year. And then we've got the value ETF here. TLT, interesting. That hasn't shown up here in a while. That's kind of a bet on lower rates. JA, that's the CLO ETF, which we're going to cover in the B block, that's had a ton of inflows over the past year. And here, a little love for international. So people starting to try to bet on something else besides U.S. large cap growth. Let's look at the outflows, and this is where it gets more serious. Look at these funds at the top here, SPY and IWM. These are the trading crowd favorites. The ones that came out in the 90s that are very liquid, they're predominantly used by traders. So the traders are leaving SPY, leaving IWM, the Q's seeing some outflows. So that tells me that the trading crowd is spooked. But remember, we just saw the Vanguard fund seeing inflows. That brings me to one of my favorite charts. We have two indexes that track ETFs used by traders versus ones used by buy and hold investors. And this is the monthly chart of those. So all last year, the second half of last year, both traders and buy and hold were on the same page, everybody buying into the market. But they have split to start this year with about $11 billion still going into the Vanguardian type funds. And then here, $12 billion coming out of the real liquid funds that the traders use. So, Sonali, interesting development here. We'll see if it persists. But right now, trading crowd is spooked by something.
And we're going to bring in now Kristy Akullian of iShares. She is the head of iShares Investment Strategy of Americas at BlackRock. Kristy, you know, when we speak to what Eric was pointing out here, that the crowd is not all going in one way. And then you look at a market that is facing periodic sell-offs, as we are today. How much are investors looking to the ETF industry to hedge?
Yeah, absolutely. And thanks for having me. You know, I think that's a really interesting point. And, you know, as we would expect, as a bull market gets a little bit longer in the tooth, it tends to get more volatile. So even though our risk outlook that we just came out with for 2025, our investment directions piece, we are pretty risk on, we're really deliberate about the types of hedges that investors need just to be able to sleep at night in this type of market where there are a lot of risks and a lot of unknowns. So, you know, one of the things that we've been focusing on is, even though we're overweight equities right now, you know, one of the things that investors constantly, we hear from them, is just that bonds have been an unreliable source of diversification, especially in the very long end. So we like pairing equities with still fixed income, but also looking outside that at some alternatives. And some things like gold and Bitcoin have served as interesting hedges in these markets, but also being really specific about what you put into your equity portfolio, what you put into your fixed income sleeve as well.
Yeah, so I'm looking at the bond recommendations here that you have, and one of them is CLOA, CLO ETF, which they've been obviously booming. You saw JA was on our top list here. Is that getting success because it does have different metrics and dynamics than your typical aggregate bond ETF or treasury bond? Are people looking for alternatives in the bond world?
Yeah, I think so. And I'll broaden it out a little bit too, and I'll just include the broader plus sectors. So thinking just beyond the ag, I think BINC, B-I-N-C, is another great ticker that investors are looking to get attractive high yields that are on offer, but keeping in mind that credit spreads are actually pretty tight. So there's reward and there's risk. But I think that looking beyond the ag, looking at some of the securitized asset classes, looking at select emerging market debt, I think investors are looking to get more selective. And this is an environment where active management actually makes a lot of sense, and how you get selective and choosing sort of a high conviction manager, like something you might get in BINC, makes sense too.
You know, it's interesting. Another ticker that you put on the list here is IEI, and you're looking at securities here from 3 to 7 years. Your colleagues have been pitching the belly of the curve here. But Eric, I know you were sitting here thinking you'd even go shorter.
Yeah, I don't get the belly of the curve. Help me out here. If you think the rates are going to have to come down because the Fed messed up or something, you buy TLT, right? I get that. If you just want income, why not just get 2.2% with like no duration? Why on earth would you buy the middle?
I think the point is that you still need some duration. So while we've seen long-term bonds and sort of that breakdown and negative correlation between long-term bonds and stocks, we've actually seen the belly outperform. So it looks to us like a better proposition between risk and reward of that you're still getting attractive yields, but you are getting some duration in case growth slows down. So you need ballast in a portfolio. You can't just be all on the front end. I think being selective about where you source that duration from is the most important in this environment.
You know, it's interesting. There's some other tickers on here too, and you know we can do this all day long with talking about duration here. How long is too long almost? There are some tickers here that I'm interested in because I'm wondering, Kristy, if they're kind of like a hedge fund replacement strategy. You look at, for example, BIMBX. This is a multi-strategy fund that you're talking about here, and BDMIX, I mean, an equity market neutral fund. How much are investors looking for kind of these more sophisticated ways of hedging that perhaps used to be more affiliated with hedge fund strategies?
Yeah, no, I think it's a great question. And I'll give you a little data point about why investors are looking, because I think they certainly are. So if you look at just sort of the pandemic era onward, so post the Great Moderation, the more positive relationship between stocks and bonds, so looking at stock bond correlation, has actually meant that the risk of a 60-40 portfolio has gone up by about a third. So, you know, that the lack of diversification that you're getting from longer term bonds has to be made up for elsewhere. And I think that's what's driving investors to think about some of the alternative strategies. And yes, there's certainly demand for that in pockets. And I think that it makes sense in a portfolio. I think there's ways that you can get that diversification, and there's ways that you can build resilience into a portfolio, even just looking at your stock sleeve and your bond sleeve as well. For example, we talk a lot about staying up in quality in equities. I think QUAL is a ticker that we have, you know, investors have really gravitated towards, and we think that they're going to continue to do so this year. Looking at some of the shakiness that we've seen in the equity market thus far, just to start this year, a lot of that has come from the fact that longer term bonds are higher. I would say that, you know, the higher longer term interest rates can go, and the higher that they stay there, the more we would expect quality parts of the equity market to outperform the rest. So being deliberate about what you allocate to within stocks, within bonds, and then thinking outside of that as well.
And I want to get your take on international. This is a part of many people's portfolios. I wrote a note about a week ago saying that Jack Bogle has been proven right. In '93, and then since then, he said, you just don't need it. Just stay with the U.S. You get enough international connectivity with those stocks, and those countries just aren't as dynamic and risk-taking as the U.S. Don't bother. Almost nobody agrees with that, but are we going to finally have a era, even 6 months, where international leads U.S.?
You know, I say don't write it off altogether. We still do prefer the U.S., and we think that the stronger U.S. economic growth profile is going to translate into stronger corporate profitability as well. But that said, there are always pockets of opportunity, and I think that the diversification benefits are a reason in and of itself to look outside of the U.S. to make sure that you're holding more of a balanced portfolio. But there as well, you know, we have a strong preference for staying up in quality. I think dividends internationally is a really interesting play right now. Something like BIDD is our you know, higher quality international dividend product. You know, that's starting to get a lot of interest, even though it's a newer fund. And I think that is a unique but selective way to add to international equities without just buying kind of the full index.
I want to go back to the U.S. because I think we're all just fascinated with the bond market right now. And, you know, I take your point about some duration. But even at the shorter end of the curve, if you look at the 2-year yield, it's totally rallied since its September lows. So what's the right entry point for something like IEI, especially when bonds under 10 years have still lost money?
Yeah, I mean, I think that the backup in yields is obviously a better entry point than where we were a few months ago. But, you know, stepping back even further, I think all-in yields and fixed income are still attractive. We are not expecting to count on a big boost from the duration side of the ledger. We like focusing more on the income side of fixed income. So clip those attractive coupons and take advantage of those higher yields, but don't just focus on duration as being the driver of returns for this year.
Kristy, we thank you so much for joining us today. That is Kristy Akullian of BlackRock. And coming up, we're going to talk more about CLOs. Janus Henderson is looking to replicate the success of one of its U.S. funds, this time in Europe. We're going to talk more about that launch next. This is Bloomberg. This is ETF IQ. Stick with us. Welcome back to Bloomberg ETF IQ. I'm Sonali Basak, and it's time for the ETF Brief, where we highlight stories and trends that caught my eye. I want to start with Bitcoin because those ETFs are still seeing a string of outflows, and that comes as the price drops below $92,000 for Bitcoin, and that's the lowest level in nearly 2 months. And you can see how much that has been a reversal from what you've seen for most of the year. Despite the recent outflows, though, the Bitcoin ETFs have helped fuel a record amount of ETF launches. More than 1,900 ETFs debuted globally in 2024, with the US, Europe, and Asia smashing records. And I want to stay in Europe because CLOs, as an asset class, have seen a surge for both the US and for Europe. Janus Henderson is hoping to jump on this growth by launching its first ETF tracking European CLOs. The firm is looking to replicate the success of its U.S.-focused ETF, JAAA, or JA, as Eric likes to call it, which amassed more than $17 billion in assets in just less than 5 years. We're going to talk more about this with Henry Jim with Bloomberg Intelligence. Really interesting timing for this particular ETF in Europe, especially as there's been a lot of discussion about the boom pending in leverage loans, which fuels the CLO industry as well. What kind of demand do you think this is going to have in Europe after what we've seen in the U.S.?
Well, it's still too early to say. We've only seen a couple of launches, with the most recent one just last week by Janus. However, the ETF issuers definitely see an opportunity in the space. We already have a couple of issuers filing for more CLO ETFs. So we should have a better idea in the next few months, but the issuers definitely see an opportunity.
Yeah, no doubt. And, stuff gets tried out here in the U.S. Usually it can be a hit over there. The numbers that JA is putting out are ridiculous. Let me give you this. It's up 7.2% in the last year with a standard deviation of less than 1%. So it's 1/12 the volatility of the aggregate bond index. So it has a Sharpe ratio of 9%. That's quadruple SPY. And it's got no correlation. It's like an institution's dream. That sometimes gets overlooked. But in Europe, are investors savvy enough to pick up on some of those metrics that aren't just sort of shiny object-ish?
Absolutely, especially since the ETF market in Europe is over 80% institutional. So these metrics will definitely play well here in Europe. Compared to the US, where it's only 50% institutional, and it's already had such good success there. So it's definitely going to play well here in Europe, Eric.
What about the rest of the market in Europe? Beyond the idea of more CLO ETFs coming to market, what is the rest of the issuance schedule coming to look like?
It was a great 2024. We saw over 200 new ETFs reach the market, a record in flows, 250 billion into ETFs. We're seeing assets double every 5 years. So if we have the same year in 2025 as we saw in 2024, it would be not just good for CLOs, but we may be reaching 3 trillion in assets from just above 2 billion right now. 2 trillion.
Yeah, it's remarkable. And Henry, bonus question here for you. ESG. Europe is like ESG's Alamo. It's where it's hanging on. What's going on there? Is ESG still as popular in Europe as it was, say, a couple years ago?
I'm afraid to say we're starting to see some capitulation here in ESG funds as well. As you know, SFDR9, these ETFs that are specifically for environmental strategies that are dedicated to promoting environmental strategies, we're seeing outflows in them in 2024 and in the start of 2025. So they're having a tough time here, Eric.
Henry, we thank you so much for joining us from Geneva. Of course, that is Henry Jim with Bloomberg Intelligence. And still ahead, we're going to drill down with Vaneck CEO Jan van Eck. He is coming to talk to us about, of course, everything in the equity markets and Bitcoin as well. Also, a reminder, don't forget to listen to Eric and Joel Weber on Trillions. It's their podcast that covers the industry. This is ETF IQ on Bloomberg. This is Bloomberg ETF IQ. I'm Shonali Basak. Eric Balchunas from Bloomberg Intelligence is back with us for today's drill down, where we focus on just one ETF.
Shonali, today we are covering RAX, R-A-A-X, which is the Vaneck Real Assets ETF. Okay, what are real assets? These are investments that are sort of more physical in nature, physical assets. So things like commodities, real estate, infrastructure. I'll go over the holdings in a minute. It's actively managed. Came out quite a while ago. 77 bips is the fee. It's 96 million in assets, right? Almost 100 million. So let's look at the holdings. This is what you're getting here. It's effectively an ETF of ETFs. So like most issuers, they're going to use their own products when they have a choice. So like they got Vaneck commodity here. This is going to be a MLP, pipelines. That's broad energy. Then you've got materials, real estate. You've even got infrastructure, uranium, steel, gold miners, water. That's been in play obviously recently. Agribusiness. So, you know, all the things that we rely on as a society, frankly. So this is institutions like this kind of trade because it hedges inflation and it can diversify a portfolio. Let's look at the performance of this. Now, I put it against SPY. Probably not, you wouldn't benchmark it against this, but just to give you an idea, obviously it's underperforming, and that's why sometimes it's a hard sell in up markets. But look in 2022. That's when the market had a rough year. This is SPY going down, right? Lost 18%. This one had a nice year. It actually ended flat, but that was obviously a lot better than down 18%. So, Shonali, interesting strategy here. Probably going to get more looks when the market is shaky.
Is it an inflation hedge? Isn't it? We'll talk more about that, Eric, with our next guest, Jan van Eck, CEO of Vaneck. And it's interesting because you can ask that question of this ETF as it stands, but then there are a lot of assets that it holds and some that it doesn't. That might serve that purpose as well. Do you see people looking to hedge against any potential future inflation?
I think investors still are so used to low interest rate environment, and it's hard to get them worried about inflation. It's something that we started talking about last year because as a kind of macro firm with our philosophy, we look for what's the dominant fact out there in the world economy, and to me there's one. It's the U.S. Government spending is out of control. It's got 2 feet on the gas pedal. So this kind of concern about inflation has ticked up recently. I don't know if it'll survive. The thing about this fund is it's designed, as Eric was talking about, to kind of perform in different market environments, like a 22 or like a last year, because underneath the hood, it really shifts its allocations actively.
You know, we talked about earlier with Henry. Are these strategies that are diversifiers tough to sell to advisors when everything's up, right? It's like an umbrella. You forget it, and then when it's raining, you buy it with the guy staying at a Penn Station. For like $5, right? Is it that kind of deal where once the market starts going down, you'll be able to sell this easier?
We're hoping for a compromised position to that, which is you should think about commodities, but you're too lazy to, right? So let Van Eck do the thinking about the commodity allocation. Is it gold bullion like last year that helped the fund up 600 basis points in contribution? Or is it going to be MLPs and energy like in 2020? No one wants to worry about that, Eric. So we're hoping that the laziness factor kicks in, and actually we offer this both as a model as well as an ETF.
You know, speaking of ETFs, the success of the Bitcoin ETFs last year were very palatable, and then you also now see Bitcoin trading below $92,000 still on a day like today. How are clients thinking about Bitcoin holdings with the near-term volatility? You've seen some of the excitement kind of wear off since the initial Trump victory. Yeah,
well, I place Bitcoin, you know, we've been advocating for it since 2017 in these kind of traditional Bitcoin 3-year cycles. So this is the last year, so it should go up if history is an indicator of Bitcoin technicals, but you get vicious drawdowns, like up to 25% in those years. And what it is, it's as investors taking profits, right? And then new investors coming in. And it's a very volatile asset class. To me, the disappointing thing as a Bitcoin advocate has been the high correlation with the NASDAQ over the last 6 months. You know, just as a lot of people are looking at it for the first time, that's not what you want. If you look at the 10-year correlations, they're almost zero, which is really what a diversifier should be. So anyway, we'll have to see how Bitcoin performs going forward. It's a little bit of a negative for me.
Yeah, but on the flip side, being hot sauce to equities, high beta, it has worked well for it this year. It's up 100%. That's my theory, is that the stock market is the biggest Achilles heel to Bitcoin. If stocks go down, I think Bitcoin has a tough time going up. But anyway, I got to shift real quick.
As a risk-on asset.
Yeah,
yes.
as a risk-on asset. But that's okay. I just think that it's got a unique trait that way. You have filings for XRP and Solana, S1s in. We're anticipating sort of like an explosion of altcoin ETF filings. You guys were early with these. We've got HBAR, Litecoin. We now have a more favorable administration and SEC chair. What's this year going to look like? Should we expect a lot of these ETFs to get approved and hit the market?
I would be cautious on that. So we have 13 funds in Europe that are single token or multi-token. So we have a broad array. But I would say in the United States, what I've been saying is that it's not really clear what direction regulation is going to be going into in the crypto sphere, because the crypto people didn't know really what they want. They're so happy that Gensler's gone. And I don't think it's that easy for regulators to start setting a direction. Separate topic, but I'm pushing for kind of a safe harbor for new software projects. But I don't know if that translates into the clarity between the CFTC and the SEC. That is an epic regulatory fight.
You know, another thing about regulation here is the prospect of a private credit ETF being passed by the SEC. Of course, Apollo and State Street have one in the hopper. What do you think of that?
Not a fan. I think the big secret thing about ETFs, not so secret, but is liquidity around not just the ETF, how it provides liquidity to investors, but also liquidity of the underlying. You know, and so since we have a BDC ETF, a CLO ETF, we've got vehicles that give you a lot of the same exposure with liquidity.
But
why? So what's the pickup, right? Why, and especially why does it have to be in an ETF format?
30 seconds left
But
here.
you also have HYD. That holds some illiquid stuff that traded at huge discounts. I mean, I just think ETFs can handle it. People like it that way.
Okay, HYD is beautifully designed by Van Eck because it has a max of sub-investment grade.
Jan, we thank you so much. My God, is that going to be a topic of discussion this year? Whether that gets done and whether the liquidity profile.
Yeah, this
fits
is the
the
new
bill.
hot debate, the privates.
Right?
Yeah.
Let's see if they make it. You could read all about the drill down plus the latest in the ETF industry when you subscribe to the weekly ETF IQ newsletter. You're not going to want to miss it. That does it for Bloomberg ETF IQ today. I'm Sonali Basak along with Eric Balchunas. Next week we'll be on Wednesday at the same time of 12 p.m. Wall Street time. This is Bloomberg.